Good to go? Okay, great. All right, we will, hold on. Maybe get started. Give us 1 second. Sorry, guys. Technical difficulties. All right, guys, so looks like we're having a problem sharing here. So we're just going to go ahead and talk you through. So we're here today to talk a little bit about financing your scaling F&B brand. So we're going to talk you through various debt options for your businesses based on what stage of the company. Hopefully we prefer a open dialogue and a back and forth. So please, at all times, if you have questions, feel free to answer them along the way. We have more fun when it's a conversation. So feel free to interrupt and we'll keep the dialogue moving forward. But I'll start by just making a quick introduction. So my name is Jessica Bates. I'm with Dwight Funding. I head up the business development team here. And Dwight Funding, we provide working capital solutions primarily to scaling consumer product brands. So basically what we're doing is we're providing revolving lines of credit, which is non-bank asset-based lending. And we'll be talking about that debt structure a little bit later on in this conversation, by lending on AR and lending on inventory. So with that, I'll pass it off to my colleague, Simon. Oh, there we are.
Hey.
Whoa, there it is. So Lauren, if you want to go ahead and click to the next. Perfect. All right. So I'll pass off to my colleague, Simon, who will talk you through himself and a little bit more about what Dwight does.
Oh yeah. Hi guys. My name's Simon Binlos. I'm a BDO here at Dwight Funding. As Jessica said, it's a reasonably tight group of people, so we kind of like to have an interactive session. We'll obviously lay out the parameters of what we're going to talk about and give you some sort of guidelines, but at any stage, interject. But yeah, as you can see on the right-hand side here, there are a couple of current clients that we have, but we've been doing this for over 8 years now. We've spoken to thousands of food and beverage businesses. So like to think of ourselves as somewhat experts with helping early stage and hyper-growth companies get through various stages of their business. And what we're going to do today, Lauren, could you just switch to the next slide? There we go. So what we're going to cover off today is basically the different types of debt and at what stage of your of a business's life cycle these pieces of debt can be used. We're going to explain kind of the most broad pieces of debt. There are many instruments out there, but we feel like these are sort of the most applicable for now and at the various stages that we'll cover off. And then we're also going to share a list of kind of things that we would advise as an entrepreneur you have in place or have at your fingertips. So when you get into a debt conversation with any debt provider, these things will be useful. And then we'll kind of go off into the some questions for you guys at the end.
We can go on there we go. Okay, so we have, so this is just a visual of, various life cycles of a growing and scaling food and bev brand. We've broken it down into 3 categories, which is traction and refinement. I would think of that as, from very early stages, like startup stages, to the point that there is proof of concept, with your product. So I would say like very early stage, startup stage to about 2 million in top line revenue, which then I would say is more of the scaling profile here. And I would say that scaling profile takes you from that 2 million in sales up to the point that the company is really steady state. Growth has teetered off a little bit. It's a little more, it's a little less hockey stick and a little more straight line growth, and profitable businesses, which is what we are thinking of here as when a company has hit maturity. So there are a few different options, again, to Simon's point earlier, that we'll be discussing. So when you're in that traction and refinement stage, the two most common forms of debt that are available are revenue-based financing, which tends to lend itself towards earlier stage brands that have a primary focus on direct-to-consumer businesses as their, or direct-to-consumer as their sales channel. There's also purchase order financing, which lends itself to an earlier stage wholesale focused business that is getting a PO here, a PO there, and are really at their starting stages of building out into wholesale channels. Scaling, once you're in that scaling profile range, the most common forms of debt are venture debt, which is really only available to venture-backed businesses. And we'll get a little more into the specifics there throughout this dialogue, as well as non-bank asset-based lending, which Dwight is a non-bank asset-based lender. And this applies to companies that have hit that sort of proof of concept stage of 2 million plus in revenue. Equity-backed or bootstrapped businesses, doesn't have to be equity-backed. And this product really can take a business up to that point of maturity, up to that point where the company is profitable, the company has a bit more steady state growth. And then bank asset-based lending or bank financing can then become available. And this is more, the bank ABL and bank financing really applies to more steady state established businesses that are profitable and have been for a year to multiple years.
Cool. Move to the next, yeah, perfect. So so what we'll do here is just go through specific products, give you kind of like a high level on that product, how it kind of works, the cost of it, and how it's kind of like paid back. So PO financing, which is purchase order financing, is for businesses that are on the earlier stage launching into wholesale. So they're moving into Target or Walmart and they're getting their first purchase order from them. It's used by the business to help grow those inventory builds, the manufacturing costs that will be incurred for launching into those retailers. It typically takes probably a few days to a few weeks to get in place, and you know, the timeline and the speed will cover each of these products off, but relatively from left to right, it gets more time consuming to get these pieces of debt in place, the further along we go. It's typically in a price range, and it obviously varies, but in probably mid-teens to early 20s would be a typical sort of price range for that product. And then it's paid back by the customer or the retailer paying, you know, you as the business owner off. A revenue-based product is typically for an early stage direct consumer brand, and it's used to help build inventory to keep up with growth. It's relatively quick to get in place. So again, a kind of few days to a week is probably typical. The price range again varies, but is typically in the sort of mid-teens to mid-20s range in terms of an interest rate that you would be charged, and it's paid back through revenue, normally taken on a daily basis from a business's Shopify, for example. I guess, guys, we haven't had too much sort of questions. Are there any questions on those two products before Jessica kind of like goes on to the other three on this page?
Hi, my name's Craig Knowles. I'm co-founder of Team Kitchen. I have one question regarding omnichannel businesses, you know, ones that are a blend of wholesale and direct consumer. How do you approach those kind of businesses?
Yeah. Oh, go ahead.
So yeah, I mean, it will depend on the stage. I think, as Jessica said, what we're trying to do here with the presentation is sort of take you on a journey of typically where a business's revenue will interact with different people, with different products of debt. So sort of most businesses that we deal with today are omni-channel, right? So even on the earlier side, they are selling through their own website, and if they're a product-based business, they might have some sort of early stage wholesale, whether that's with larger retailers or with boutiques at the moment. So it really sort of depends on the stage of the business to which different piece of debt they can utilize, right? If you're an early stage business and you're doing both wholesale and direct to consumer, you could do PO financing and revenue-based financing. And the same is applicable, as Jessica will cover, as you start to scale with brands that are using us as a non-banking ABL lender, but they can also utilize venture debt as well. So sorry to put you on a question to your question, but it really depends. It would say, like, where are you at in the stage of your business, and different bits of this debt can be applicable at that stage.
Great, thank you. We're very early stage, and so, you know, for us, it's just helpful to know what the options are so we can start thinking about them, you know, early on and build around that.
No, that makes a ton of sense. And just to add a little bit of color to what Simon was saying, the reason one or the other doesn't necessarily work for an omni-channel business is because when you're building for potential future revenue-based financing is backward looking, right? So it's only going to be, it's going to allow a multiple that'll provide you the ability to get some inventory for backward looking sales numbers. Whereas if you're wholesale driven, you don't get paid on those sales for quite some time after the actual sale. So looking backward doesn't fully capture what your inventory build need is going to be for wholesale going forward. So at these earlier stages for an omni-channel business, it may not be either, or it may be both. Now, as you start scaling and you start getting into these other kind of lending profiles, these other lending profiles typically only allow their structure. So ideally you're finding groups that cover kind of all of your needs, whether you're direct to consumer or wholesale driven going forward. But in the earlier stages, those limitations don't always exist. So you can do both simultaneously.
Thank you so much.
For sure. Any others? Okay. All right. So moving on to some of the options that are available, again, as you know, the company continues to scale and that proof of concept is there. So I'll start first by talking about non-bank ABL, which again is what Dwight does. So typically for a non-bank asset-based lender, a company needs to be doing about 2 million plus in annual sales or a run rate of that. And what the use case is really for working capital financing. So when you have AR and you're waiting for customers to pay, which happens as you're building up wholesale, and for inventory build, whether that's for wholesale business or for direct to consumer sales. So asset-based lending funds based on what the business has in AR or inventory at any given time. It's a good product for scaling because as the company's revenue scale, the assets have to scale as well. You have to build your inventory more. Your AR, your accounts receivable, is going to naturally grow. So you're given advance rates. Typically, it's like 85% on AR, 50% on your finished goods inventory cost, and that determines how much you can borrow at any given time. However, those advance rates remain the same. So as your assets grow, that continuously provides additional availability as the company scales. So it can be a really good product for a scaling business. One thing to note about non-bank ABL is if you have the assets, the AR and the inventory, typically you could be bootstrapped or you can be equity backed. If the company is not profitable, generally speaking, an asset-based lender is going to want to see that there's some sort of equity provider funding the growth spend And then the asset-based lender can provide all the working capital funding needs. So relative to PO financing and revenue base, we're going to call this medium cost. So generally speaking, asset-based lenders tend to be anywhere high single digits to low double digits annual cost for this product. Typically no warrant coverage, which is good because it's non-dilutive to your business and to your capital structure. A couple benefits to this relative to PO financing and relative to revenue-based financing is you tend to have a dedicated relationship manager. So it's you have someone to call in a worst case scenario. If you need something a little outside of that borrowing base, a little outside of that AR and inventory financing, or you have a situation you just want to talk through, you tend to have a dedicated relationship manager. One thing I want to point out here is that there are industry specific asset-based lenders like Dwight, where we specialize specifically on scaling consumer brands. And then there are industry agnostic asset-based lenders. It's an important point to bring up because as a scaling food and bev brand, there's a lot of very particular things, very niche scenarios that come along for a food and bev business that if an asset-based lender doesn't understand that, it could provide a little bit of tension in the lending relationship. So for example, dilution, when you sell into wholesale and you have promotional spend, chargebacks, things like that, unless an asset-based lender really understands how that works, it could cause tension between the borrower and the lender if the company doesn't receive the exact amount from their invoice that was initially expected. Whereas if you're working with an industry specialized group, they anticipate that it's not going to be, you're not going to get paid 100% of what that invoice was. You might get paid 85% or 80%, but that's anticipated and accounted for on the front end. So I might be a little biased, but I tend to think that it's important to work with a lender. When you're working with a funding source, it's really good to have a group that really understands your business in and out. It's also nice, I would think a value add, to have a group that if you're facing a challenge that a typical scaling food and bev brand does face, if you have a dedicated relationship manager who is also an industry expert, you really have someone to lean on, someone to call, to talk through your scenario, that's seen the situation time and time again with previous clients. I can say, hey, look, this is a scenario that a lot of brands face, a lot of founders face. Here's what I've seen work historically, or have you thought about this? So there are a lot of benefits with working with an industry specific and industry experts versus agnostic, but I want to definitely point out that there are different profiles there. So just on the day-to-day, it's important to know, typically asset-based lenders want to see ongoing reporting. Again, based on the kind of lender you're working with, that can be light touch or not light touch. So for groups like Dwight, we've specifically spent a lot of time building out technology that makes it very low touch ongoing reporting. So a lot of reports are automatic. It doesn't take a lot of heavy lifting from our clients, but not all asset-based lenders are that way. So just to give you the lay of the land, so you know what questions to ask if you're considering this down the road. So I talked a lot about that. I'll stop there, see if you guys have questions on that one, and then we'll move on to venture debt if not. Okay, so venture debt. Venture debt is a very different kind of profile. So the real use case for this is if you have gotten venture capital and you want to increase your run rate by 6+ months. Venture debt can be a solution for that. venture debt is typically provided by a bank. There's some non-bank venture debt providers, but they're very, very, very expensive. So we're going to stick to the bank venture debt profile. The way that this structure works is the bank will provide the company a lump sum based on how much you raised, how much runway that gives you, and the expectation that you're going to be able to raise your next round. That lump sum typically can carry you 6 months plus past your initially intended next raise date. So it gives you some time to hit some additional milestones before raising again, potentially increase your next valuation. What I will say is there are some real considerations with taking this kind of financing. So it's low cost from a rate standpoint, which means you're going to have bank rates, which tend to be like mid-single digits, mid to medium high single digits, digit annual rates. However, there's going to be a warrant component, which means it is dilutive. So they are going to basically have an equity stake in the business. It'll be relatively small, but if the end goal is an acquisition, from a dollar standpoint, it could turn into a pretty substantial dollar amount down the road. So just worth considering. The other thing that I'll mention about venture debt is typically it starts as an interest-only structure. The interest amortizes, it starts immediately, and then it starts amortizing typically after a year. What I will say is that's should be a really big consideration if the company does not intend on being profitable within a year. Because if you are amortizing debt while the company is still loss-making, you're basically using equity dollars to pay down debt. So just something that you want to consider when taking that on. Again, I'll stop there before we move into the maturity section, which I'm going to talk through very, very quickly, but want to make sure we have this kind of what these two main options that are available during this scaling stage. Okay. Once a company hits maturity, it's been profitable for a couple of years. It's not, you never have dips, ups and downs. It's really more steady state. The growth may not be like that. It may still be growing, but just not quite as, up and down. Then regular bank asset-based lending or regular bank commercial lines start making sense. This is the lowest cost solution. There are a couple factors to consider with this, which is some of these factors make it not as appealing of a solution for a scaling brand. And that is that this product typically comes with heavy covenants. And that could be revenue covenants that say, hey, you have to hit these revenue numbers each month, or EBITDA covenants. You have to hit this amount in EBITDA every month or every quarter. The reason covenants like that aren't, as ideal for a scaling brand is it's much harder to predict when you're scaling rapidly. It's much harder to predict if you're going to have that revenue every month or that EBITDA every month. There are challenges along the way. There are speed bumps. So it's really not until the business is totally mature and it's not as tumultuous that bank lending starts to make sense. If those covenants aren't hit, again, there can be friction between the lenders. Oftentimes what happens is the bank will cut off the borrowing. So you really want to make sure you're in a position and your company is in a position that those covenants are not a challenge. But then once you're at that stage, a bank product can really start to make sense and becomes the lowest cost solution. No warrants, just those lower rates of low to mid single digits.
Cool, guys. Well, yeah, thanks for running. Glad that we were able to run through the major broad strokes there, so we can definitely go through some questions in a little bit. But what we've done here is just, I guess, in our kind of experience of talking to early stage businesses, these are sort of a few things that you need to either have in place or have access to in terms of information when you're talking to a debt provider, to make it as streamlined as possible for both parties. I'm not going to run through every single one, but you have it there, and obviously we'll share through the presentation with you so you can have it. But yeah, the key ones is obviously having your accounting in order, in something you can share with a group, because that is one thing that they will definitely do. And then a lot of the businesses that we work with don't require a full-time CFO, right? Because they just don't have that need, and so they use fractional or an outsourced CFO company. We're familiar with a lot of them in the space, so if anyone on the call wants to kind of get introductions or anything there, we're very happy to do that. And then now I guess I'll just kind of open it out to the group to go through any questions that you guys have on the product or the process, or kind of what we see, or even things that we kind of haven't covered off, but maybe you've heard about but want to get a little bit more information on from a debt perspective.
So we do have a question from Ross, who says, what is the term for the type of lending that Dwight does? Payback begins immediately. What is the term of the loan?
Yeah, so we do non-bank asset-based lending. So we fit into that non-bank asset-based lending category. Payback is different with a non-bank or with a revolving line of credit, generally speaking. As long as your company has the assets to support your balance. So generally speaking, the amount that the company can borrow at any given time is formulaic based on what you have in AR or what you have in inventory at any given time. So to give an example, if company has 100K in AR and we're lending 85% on that 100K number, then you would be able to borrow $85,000. If you maintain 100,000 or more in AR, you can maintain that $85,000 balance, and it's an interest-only transaction. If for some reason that AR drops to $90,000, the only part that has to be made whole is the difference between 85% of 100K or 85% of 90,000. If that AR goes up to 125K, then you can borrow 85% on that 125,000 and maintain that balance as long as your AR stays at or above that 125,000. So it's basically an interest-only facility that doesn't have to get paid down as long as your assets can support the balance. Is that helpful?
I think so.
I just saw something come through. Roughly what percent of inventory value would you loan against? Do you want to comment?
Yeah, so it's obviously going to depend on the business, on the type of inventory at the stage, but so it's called an advance rate, and it will vary with inventory depending on if it's a direct consumer only brand, so it's selling predominantly through its own website, if it's lending on inventory within wholesale as well, so we're lending on AR and inventory, but the typical range of advance rate would be anywhere from sort of 40% to 65% typically. Hopefully, again, that's helpful. Like I said, I'm giving you kind of the broad strokes. Like, this is where, we talk about this list we've got in front of us of having all the information. This is where it's really important to have that information available to you when you're speaking to a debt provider, because they'll be quickly be able to look at your business, talk you through your business, and see if it's a fit for them or not. And that's really what you're trying to do. Is what we're trying to do here is introduce you to the individual projects and streamline the process when you're in that, because what we see quite frequently is entrepreneurs spending a lot of time on maybe things that aren't going to be a fit for them, but because they're not maybe educated or experienced enough to ask the right questions at the right time, it takes them a while to figure that out. But yeah, so the advanced rate question sort of answered there, and hopefully that's helpful. Any more questions we can cover off? If there isn't, there's a couple that, we get asked pretty frequently that would maybe be a good thing to kind of like share with the group. Yeah, I guess starting at the bottom, when should I start like the debt process, right? And that's what we were discussing with the different stages and different products. Like it can really start at a very early stage, because even before you have that first PO, if you're having conversations with the retailers as a wholesale business, you could get your ducks in a row with regards to who you want to speak to at the right time. So there's no really like wrong time to start doing like the debt process, but it's just being mindful of your time. And so that's what we're saying is maybe you can start at any time you want, but keep it streamlined, because you don't want to spend a lot of time with things. And as we and as I was alluding to with the early stage pieces of debt, like PO financing and revenue-based financing, they can move relatively quickly. It's days and weeks, right? From having a first conversation to funding. So it will depend on what you're looking for, but starting conversations, we always advise, start doing it early rather than later, right? You don't want a situation where you've just got the PO and you're just starting to look for purchase order financing, if that's something you want to look at. But at the same time, you don't want to do it a year out from, even being close to talking to a wholesaler. So it's really dependent on you. And that's what we're hoping to do here, is provide you with the right tools when you're having those conversations for them to be valuable and to understand like at what stage you will be able to utilize that.
Yeah, and if I can just quickly add to that, to Simon's point, when you're talking about the PO financing and the revenue-based financing, there's a little less diligence required there. There's a little less, the books don't have to be as mature. The company doesn't have to be as mature. However, when you start to advance into the debt options of a scaling brand in that scaling category we mentioned earlier, what I would say is the requirements become a little more in depth. So the one thing I would highly recommend is do not wait until you need the funds. So if you're a loss-making business and you have 6 months worth of runway in cash, you would have wanted to start those conversations when you have a year of runway in cash. You want to look for debt. I know it seems counterintuitive, but it's the truth. And it's a big piece of advice that I can give. Look for debt when your balance sheet looks the absolute best. Most debt providers at that scaling stage plus want to see that a company has at least 9 months to 12 months worth of burn covered in cash in the bank. So you can get a debt process going. You can put a debt facility in place, knowing that you're going to need it down the road, but you want to try to do it when the balance sheet looks the best. Otherwise, you may get to that 6-month runway mark and start hearing no's. So just don't wait until you absolutely need it. Do it when the balance sheet looks the best. But that actually is a pretty good segue into how do you know who the right lender is for you? Because to Simon's point, like it's never too early to start having those conversations, because it's really important when you are looking for a financing partner, specifically as you're scaling, you're going to need to lean on your financing partners. So you want to make sure that you're working with a group that knows your business, that knows the industry you're in, that can provide assistance, whether in the form of their network, whether in the form of knowledge, whatever it may be, when you need it. You also want to make sure you have a good relationship, a good rapport, that the group has a good reputation, that they support their clients in the good and bad, because as a scaling brand, you see both. So I would say, start early, have, good conversations, and make sure you're working with a group that you feel comfortable as a true financing partner.
Another one that comes up, obviously, we're spending a lot of time around debt, because that's what we do. But obviously scaling brands also get outside investment, whether, as Jessica said, it's through venture capitalists, private equity, family offices, family and friends, whatever it might be. And a frequent question is like, when do I use one or the other, or do I do both? And obviously it's a very like broad topic, but in most cases with scaling brands, it's probably both, but at different stages, and it may be at different times in their business. And so what we're trying to do here is give you the tools to maybe solve for the debt side of that answer in your head. And the equity side is obviously down to you. We're in a very fortunate position with a lot of the brands we work with. They have, venture funds invested in them. So one of the things we do a lot with early stage businesses is when they are looking for equity, we can make introductions to different equity providers, bearing in mind what they're looking to raise, what types of groups they're looking to get in front of. But that's something we do a lot, because what we want to do, if the business is a little bit too early for us to work with, is we want to set that entrepreneur and that business up. So when they do go through that scaling stage, they will be in the right position, have the right tools, have the right fundamentals in their business, so they can access that level of debt.
Awesome. All right, great. So listen, first of all, Adrian, thank you so much for inviting us here. We really appreciate the opportunity to talk to you all. We're available, and we're happy to, have additional conversations if you want to just, talk shop. Feel free to reach out to us.